me great pleasure to be your hostess, and I'm excited that each and every one of you have decided to join Be the Movement. B is an acronym for Black Economic Empowerment. And we endeavor ourselves to uplift the community, to help to cultivate Black wealth. There will be 4 sessions that we will provide in collaborations with others who feel the same way as we. One session will be this evening, and I'm really excited about what you're going to have, what we have in store for you. Oh my goodness. The next one is going to be Thursday, and then again next Tuesday and the following Thursday. When I think about a bee and what a bee symbolizes, it symbolizes strength, very good, strong work ethic, and dedication. It signifies the importance of stopping by and sucking in the nectar. And that's what you all are doing tonight. You stopped on by and you're going to suck in the nectar of the blessings and the rewards that life has to offer through Black economic empowerment. What I'd like to do at this time is introduce to you the founders of B. First, we have a life insurance and real estate broker, Juavette Johansen. Living benefits coordinator, Jill Johnson. Insurance strategist, Helena J Conley. We also have a financial consultant, Anita Ferns, and yours truly, insurance education provider, I'm Lisa Lewis McCombs. The individuals that are going to be our featured speakers today, we're so honored to be able to have Steve Peterson. Steve Peterson is the broker owner of Infinity Investments. I'm going to speak a little bit more about him later on. On Thursday, the 18th, we have Nikia Carter, mortgage and real estate broker and proprietor of Carter & Carter. Thursday, she's going to talk about the quality of home buying and the process thereof. A week from today, on the 23rd, we will have Chris Horton, and I'm really excited about his mission to help launch 100 new Black-owned businesses. 100 new Black-owned businesses to help to provide funding for existing businesses or those who are looking to open up a business. And on next Thursday, one of our very own founding members, Anita Ferns, is going to talk about Black Wall Street. How powerful is that? We also like to encourage you to attend all 4 sessions, as we're going to have a drawing for those that attend. We know that you've registered for tonight, but we want you to register for each and every one of the sessions. As we continue to scroll down on the screen, you will see our partners. So we would like to thank each and every one of the partners who have sponsored this event for the evening to collaborate with us to be able to make sure that this information is available to you. We also would like for you to be mindful that this information is extremely important, and we would like to be respectful of the speaker and make sure that we mute our microphones. For the sake of time, we will ask if you have any questions that you would directly reach out to our esteemed speaker, and he will be more than happy to be able to accommodate you with the answer to your question. Now, ladies and gentlemen, without further ado, I would like to introduce to you an individual that comes power-packed. He's a broker owner of Infinity Investments, a full-service commercial real estate investment firm. He earned his CCIM which is a certified commercial investment member designation, which is the highest designation in commercial real estate. Steve has passion for serving the community and increasing Black home ownership. Steve has served as the president of NorCal CCIM chapter in 2018, the president of ARPB, Associated Real Property Brokers, from 2015 through 2016, and the president of KRAB, which is California Association of Real Estate Brokers, in 2017 and 2018. If we were all together up close and personal, we would give an applause. But since we're here meeting virtually, what we're going to do is applaud by offering spirit fingers. So with everybody, let's come together as we bring to the platform none other than Steve Peterson.
Thank you, Lisa. Thank you. Thank you. I appreciate that warm welcome, and I appreciate y'all having me here this evening. I really, really support and believe in everything that y'all doing in terms of Black economic empowerment and excellence, and pushing the ball forward in terms of what we need to do as a community to, to build generational wealth. We've been stripped so many times of things, all things concerning wealth, that we need to really start fighting back, and what the great thing that I have seen over the last couple of years, particularly working with Juavette and all of her network, is that there is an awakening in our community, that enough is enough, and we need to start building our own just network, a foundation of wealth building. And so I really appreciate y'all having me here this evening. And I'm going to be talking about just some fundamental things in terms of analyzing investment, right? And so I really appreciate you for bringing me on this evening. And I have a presentation that I can break down and go through with you guys. I wanted to ask you, Lisa, about how long do you want me to speak this evening?
40 great minutes.
Beautiful.
Thank you, Helena.
Beautiful. Okay. And so if it's good, I see I have ability to share my screen. I'm going to pull up my presentation and I'm going to jump right into it. So we're going to make the best out of this 40 as we can. And I, again, appreciate y'all for having me on. And, I'm looking forward here to getting into this meeting. So I'm going to be talking about, as I bring my presentation up, I'm going to be talking about the introduction to multifamily and commercial real estate. The biggest thing that I see is an issue, essentially, is understanding how to know what you're talking about, know what you're looking at, and know what you're doing in the business, if you will. That is, very, very important. So if you're going to get into this world of investing, you got to understand what you're doing. And so that's kind of what I'm going to be talking about. I'm going to map out the analysis process, what makes a good deal, what makes a bad deal, and how you can use this, whether you're looking at a single family home to purchase, whether you're looking at apartments, whether you're looking at commercial type properties, whatever it ends up being, you want to make sure that, you know what you're doing. Okay. So I typically will do a, go through the presentation and ask for questions. I don't know how y'all want to do it, but if we have questions that as they pop up, I can get to them. If we want to, just kind of go and,
If anybody has any questions, just put them in the chat room, then that way we can gather them all to make sure that we're on time.
Okay, sounds good. All right, well, I'll get into it here. You guys, hold on 1 second. Let me bring this. Let me get this. Let me start this slideshow. Hold on, I'm having a little bit. There we go. Boom. From the beginning. All right, so now we're gonna get right into it. Lisa did a great job breaking my story down. I've been, one thing to take note is I'm born and raised in East Oakland. I'm from Brookfield, and that shaped a lot of who I am and what why actually I went into commercial real estate. And having pretty much lived in apartment buildings my whole life, is I wanted to get into a business where, I could affect change And I felt like in the commercial business and apartment buildings particularly, I could be a part of the housing solution. So that's kind of what I think that's important. And being from the town, it's definitely a unique place. And I feel gives me an advantage in the marketplace. Being able to look at things differently. Most commercial real estate people don't really know that side of the world. And so for all of us who may be, from the hood or from the, tougher parts of town, the thing I think is using that as an advantage, actually. There's a lot of disadvantage. We got a lot of things against, but actually, we could use that as an advantage as we go into the corporate boardrooms and into the world of, like, for instance, commercial real estate. If we take the time to learn some of the things that are keys to success, which I'm going to be talking about today. So that was the one thing I just wanted to bring out to y'all. And I'm born and raised from East Oakland, Brookfield Village, to be specific. So when we're talking about commercial investment property, first of all, let me just break down what I'm talking about. So anything that is 5 units and above, that's an apartment, is going to be commercial property. 2 to 4 units, duplex to fourplex, that is residential income. Single family homes or single family homes, all of which can be investments. And so let me just say this. You can take this information again if you want to buy a house, you buy a hotel. I recommend multifamily properties for a lot of different reasons, whether that's 2 to 4 units, whether that's 5+ units. There's a few reasons for it. Number one, it has the most stable cash flow during what's called the holding period. The holding period is the time in which you own the property. That period of time you're going to have some ups and downs. Multifamily properties typically are going to have a better stable cash flow during that time. Also, it's going to have higher occupancy rates typically than like office buildings, retail properties, hotels, other type of properties, that are commercial, if you will. So another thing to think about in relation to single family homes is if you have a single family home that's rented out, when it goes vacant, it's 100% vacant for the period of time until you get it fixed up, until you get it rented out. If you got 10 units and 2 of them go vacant, let's just say, you still got 8 rents coming in to help you to pay other bills. And that's important if you're just getting started out and you don't have a big pile of cash on the sidelines, because people move in and move out. And if they move out and trash your place, not only are you not getting rent for that period of time, but you're also having to spend money without rent coming in. So we like multifamily properties because it gives you that economies of scale that a single family doesn't give you, and it gives you just a more regular cash flow over the period of time you own the building than other commercial properties in general. I don't want to discourage you from going after anything. You want to go after hotels. It might be somebody in there saying, hey, I want to own hotels. It might be somebody in there saying, I want to own an office, whatever. I just am recommending multifamily property for those reasons. Also, lastly, financing. Financing is very, very attractive. A lot of people don't know FHA also finances apartment buildings. Fannie Mae, Freddie Mac also finances apartment buildings, and they do so at very attractive interest rates. So a lot better interest rates than, let's say, you would get on an office building or a hotel. So a few reasons why we like multifamily. Also, this is key to consider in this period of time. When the last time the market crashed in the Great Recession, prices came down about 50%, 60, 70% in some spots. But the rents only came down about 10%. And then the rents actually started going back up at that time because there's so many people who lost their property that needed to rent somewhere. So those are just a few reasons why I love multifamily. Y'all pick what you want, and you can take these principles and apply it to whatever. But I want to give you the reason why I like what I like. Now, it's a few key indicators when we analyze in property that you really need to be aware of. Okay, and don't fall into this thing that they ain't making it no more. So if I just buy real estate, it's a good deal. Look here, especially in the Bay Area I'm in Oakland. There's a lot of rental laws, and if you get caught slipping, it could be a nightmare. All right, I'm telling you, as a person who get paid to buy and sell properties for people and buy and sell properties on my own, don't make a bad investment decision if you can help it. And the if you can help it piece is analyzing the key indicators. Number one, you're gonna look at the cash flow. Number two is the NOI details. NOI stands for net operating income and the details surrounding it. Okay, very, very important. The price and its relationship to the cap rate. Now, I'll explain what the cap rate is. The return on investment and return on equity, also the cash on cash return and internal rate of return. These are measures, indicators that you analyze when you're making an investment decision to help you, when you finalize that decision, make you confident that you're making the right move. Nothing is guaranteed in investment. Somebody did a video, somebody asked about, well, how do we know in 10 years, everything ain't gonna crash out, I ain't got no money, I'll make an investment. Look, it's an investment. There's a risk of loss. Therefore, we need to operate by some principles and look at some key indicators. And I must like stress that because we're in a period of time, especially in residential, where the market is going up, multiple offers. There's euphoria in the marketplace. We're in a period of time, the stock market went out of control. Bitcoin is whatever it is. It was 30,000, 40,000, whatever it's gonna be. Elon Musk to put a bit. It's euphoria in the marketplace. So what I seen this before, I started in the game in 2003, right? So I seen in 07, 06, right? All this things continuing to go up. When in fact, if you track foreclosures like I did and like I do, there was an extreme uptick in foreclosures. There were things out there letting us know that there's some trouble on the horizon. So the way you guide through a market is use indicators. Don't just, oh, my cousin told me they bought some Bitcoin and they blew up, or they bought this GameStop stock and they blew up. There's some quick money that you can make in and out, but a lot of wealth has been lost on people speculating and not know what they're doing, especially in real estate. Why is that? Because you're going to probably 9 times out of 10 get a mortgage with that property you buy. So you best be looking at these indicators, okay, y'all? I cannot reiterate that more in February 2021. All right, now let's get into what all this stuff means. And I'm gonna go quick, but I will go over this and give me like a 5 or 10 minute warning, Juavette or whoever's moderating, so I can bring it all in when we get there. So we talked about the number one thing being cash flow. We're gonna analyze cash flow, right? And the net operating income and all the details surrounding it. So when you're out looking for properties, by the way, you're going to be requesting, now, let me just preface this, rental properties. So this is not flip, okay? Flip is a different presentation, has a different understanding. Let me just break down what that is. When you're flipping property, you're buying property, fixing it up and reselling it, okay? Technically, what you're doing is you're dealing properties in that way. What I mean by you're reselling properties, so you tax differently than when you buy investment properties for rental income. Flip is still an investment, but it's a different kind of investment, all right? When we talking about, you really want to build wealth, we're talking about acquiring rental properties, right? And that rental property can be, like I said, it could be office, industrial. I'm recommending multifamily. But when we're analyzing rental property, the key analysis that we're looking at is to review the historical financial, the historical profit and loss statement. And that's going to let us know what the exact, the net operating income and the cap rate is and the cash on cash return. And then we're going to make our investment decision. We're going to make our investment negotiations. Another reason why we love real estate, because we can negotiate based on this information. All right. So when you're analyzing, it could be a duplex, fourplex. If it's rented out, you need to look for the last 2 years financial statements. Profit and loss statement. It could be the Schedule E on their taxes. Now I'm dealing with a couple properties, and these sellers, my client, they ain't got no profit and loss statement. I got Schedule E's on taxes, which that'll work. And I got a guy, he don't got even the Schedule E on some taxes. He don't got a profit and loss statement. He does have some bank statements. So what we take, which is not a good way of selling property, but you have to review the past in order to evaluate what's going to happen in the future. So when we get, and there's also something that's important that you want to make sure you get is what's called the rent roll. The rent roll is going to show you all the tenants who live there, what they pay for rent, what their deposit is, what their move-in date, what their move-out date, current in relationship to their existing leases. Once you get that, now you can break down the numbers. Okay, and this is how you do it. You start from the top and work your way down. We start with what's called gross scheduled rents. That's the total amount of rent that would be collected if all the units were occupied and all the tenants were paying rent. Also, another key to note, when we analyzing numbers, we are analyzing them on an annual basis, looking at what the rents are for an annual basis. So when you're looking at a rent roll, that's going to be on a monthly basis. The rent roll is going to show you all the rents coming in, and then you essentially going to annualize that. Annualize it means basically times it by 12. If it's a monthly outlook, you times it by 12. If it's a quarterly outlook, you times it by 4. You annualize it, all right? So we start with the annual gross scheduled rents. Now we take away from that vacancy rate. If your building is full, then what you want to look at is the marketplace and what the marketplace's vacancy rate is, all right? And a way to do that, there's a bunch of different resources out there. There's the Institute of Real Estate Management has, if you go to their website or just Google Institute of Real Estate Management, that's IREM. They have all kind of market reports that you can get your hands on that show you vacancy rates, cap rates, price per units in pretty much all the major markets. So if your building is full, you still want to put in the market vacancy rate, okay? Very important, because you may buy a full building, but somebody will move out at some point in time. So you need a budget for that. Also, you want to account for if there is any loss to lease or concessions. I don't know if y'all noticed this, but I'm sure we got viewers from all over the place. Here in Oakland and San Francisco, like downtown Oakland, for instance, all these newer buildings, they are offering rental concessions. Some people are doing like first month free, reduced deposits. We haven't seen those type of rental concessions for a long time in the Bay Area, but they back and they come and they go. When I was doing deals in 08, 09, I was in Ohio doing deals. We had to do 2 months free just to get people in the building. All right, that's called a rental concession. So if there is any of that activity in the past, you want to know about it, account for it. If that's happening in the marketplace, you best be aware. You need to account for that up front. Now, after taking that away from the gross scheduled rents, we're going to add what's called other income. And other income is simply that. It's any other income that is not derived from the rents. It could be laundry, it could be vending. If it's a larger building, it could be a cable contract. It could be parking, it could be billboards. Now bigger buildings are starting to have Amazon lockers. So any other way, just any other way you can generate income that is not from rental, it has to be categorized as other income. That gets added, and then you get a net number, effective gross income. When I say net, that's of the top line income, all the money that you bring in effectively is called the effective gross income, okay? Then from there, we're gonna do something very important. Now, this does not include mortgage payments, y'all. This is called the operating expenses. And the operating expenses does not include your mortgage payment. This is the cost of doing business, not the cost of capital. Very important. A lot of beginning real estate investors miss out on this point. And particularly in anything having to do with 5 units or above, we have to take this into account, because the value of your property will be skewed if you put the mortgage payment in these numbers. The value of your 5+ unit apartment building or any other commercial income property is based on the net operating income it generates. So you do not put your mortgage payment, which we call in the business debt service. All debt, if you hear somebody talking about debt service, that's your mortgage payment, all right? And we always calculate things annually. So debt service is not in this calculation of operating expenses. What is up in there is your taxes, property taxes. In the city of Oakland, we got business taxes. You got insurance, management, maintenance, utilities, repairs, reserves. You're gonna have some certain properties, you might have security, certain properties you may have pest control, landscaping. These are the costs to doing business, right? The operating expenses. If you paid cash for this building, you still would have these expenses, okay? So that's why I'm reiterating, it's no debt service, no debt cost. And this key point to note about property taxes is that when you buy the property, 9 times out of 10, it's gonna be a reassessment. Now, depending on where you are in the country, it's gonna be different. But here in California, when the property trades, it's gonna be reassessed based on the sales price. Now, an important thing you could do on every single property, even out of state, you can pull up that parcel tax information. And that's going to show you the rate of which they tax you on, and then it's going to show you any special assessments. All right, like I'll give you an example. In my house, I think my rate is 1.45%, and then I have a list of special assessments. You know what I mean? You know, in East Oakland, we got a special assessment called violence prevention. So they tax a price. If you own a property, you got to pay for violence prevention. I don't know what kind of violence they've been preventing, but you do have to pay for it. You know what I mean? We also pay for things for the school. I'm actually a proponent. When there's something for schools that pop up, I always vote yes. Yeah, I have to pay more taxes, even though I don't know where the money goes. But I know our kids need the money. You know what I mean? Especially if you grew up here, you've been to open schools, they need the money. They don't manage it well. But all that goes to this special assessments, okay? When you pull up, and that's key because this is the biggest number that gets miscalculated. And if you live in California, or even everybody moving to Texas, right? Everybody going to Texas. Texas, they don't have state income tax. Oh boy, but they got some property taxes that will bust you up in the head if you don't know about it. So all I'm telling you, every property, no matter where it's at in the country, you can look up the actual rates and the actual special assessments, and then apply that to, you know, your purchase price. But no, everywhere doesn't necessarily automatically trigger the reassessment based on your price. So everywhere is a little bit different. Just keep that in mind. If you're in California, they're doing it based on a price. So if you're looking at the profit and loss statement from the last 2 years, by the way, and I'm selling a property right now, property owners own it 20 years. Their taxes is going to be different than your taxes. All right. So the numbers can be wildly different if you don't do that. And here's why. These are the operating expenses. So you total all these numbers up. That's the total operating expenses. So you take your effective gross rents and you take away from that your operating expenses, and that gets you the end all number of net operating income. The net operating income is the gross effective rents income minus all the operating expenses, and essentially is what's left after you collect all the rents, pay your bills, but before you pay the mortgage. This is what you pay the mortgage with this money, the net operating income. Very important, all right? And it's the value of your property. It's the value of your property because people who buy income property, they buy it for income. And when the property gets appraised, we're going to apply what's called the capitalization rate to that net operating income in order to create a value, okay? So the capitalization rate, and you hear this term called cap rate in the business, is the rate of return generated by a real estate investment property based on the annual net operating income that a property generates. That's why the calculation of this net operating income is key, it's critical. You can't mess it up, all right? You're missing out money if you do. And it busted down like this. Basically, it represents the percentage return you would get from a building if you paid cash and didn't have a mortgage. Okay, so the percentage return, the annual yield, the annual money you make off that building. All right, so that's why we got to get these numbers right. And I'm telling you, so many people miss this. And I'll give you an example. I'm selling in a building right now, and the owner does not report his laundry income on his, you know, he ain't reporting laundry income. He getting coins. We ain't gonna say who it is, but he getting coins. He just, you know, he going to the Cash Creek with them dang coins. You know, I'm chilling, relaxing. But what we did, we looked at it, we analyzed the coins coming in. He said, oh, it's about 6 G's a year, these coins total. Well, that's $6,000 that's not on the net operating income sheet. If that net operating income was up $6,000, now he's in a 5% cap rate market. Now I'm about to give you an analysis, and you'll see what I'm talking about. But essentially, you take that $6,000 divided by 0.05, 5% cap rate. $120,000 of value that he just had at Cash Creek like this. You know what I mean? That's the importance of keeping good books. That's the importance of documenting things and analyzing things the right way. Okay. And this is something that a lot of people who've been in the game still miss. All right. And you gotta spend the time. This is the tedious time. It's fun to get out there and go roll around and look at properties and make negotiations and sales. And I mean, that's the fun, exciting part. But you got to sit down and go through these numbers with a fine-tooth comb. Because of situations like I just said, 6 G's off the NOI could be 120,000 off the value. Okay, and let me articulate that in some numbers here. So we said, to give you an example, if a building's NOI is $100,000 and the purchase price is $1 million, right? So we looking at a building, it's $1 million purchase price, and we do our analysis. We determine that the net operating income is $100,000. Well, what's the building's cap rate? We know it's $1 million, right? So here's the formula of how you figure out how you solve for cap rate. I'm sorry to break the algebra out on y'all, but if you got kids, you've been doing some algebra and all of that stuff recently, because we all as homeschool parents to an extent up in here. So I'm sorry for bringing this algebra to y'all, but it's easy, trust me. So you take the net operating income and you divide it by the purchase price and or value. So purchase price equaling value, same thing. And you're gonna get a number. Now, you guys know, you guys are all financial people, that's easy math. That's a 10% number. So if I got a $100,000 building, or the building is generating $100,000, purchase price is $1 million, cap rate's 10%. Now, going back to algebra, these three numbers, these three measures, net operating income, cap rate, purchase price / value, right? Because say you're trying to refinance your building, by the way, might be a good time to do that if you got a building. Then that purchase price becomes value, you know. And a lot of times when we're doing this equation, we are solving for value or we are solving for price. So these three numbers have an inverse relationship, meaning that if I know two of these numbers, I can always solve for the third. If I know that my net operating income is $100,000, and let's say the market cap rate in the market is 5%, then I take that net operating income divided by the percentage in order to get the value. How I did, like I gave you the example about the coins in Cash Creek. Well, that was $6,000 of coins. The market's 5% cap rate, and that's 100. So if I take 6,000 divided by 5%, 0.05, that gives me $120,000 of value. So these three are inversely related, is what I'm trying to tell y'all. So if you have two of these three, you can solve for the third. Typically, when we're doing an analysis of a property, the broker will quote us the cap rate, and we are essentially trying to determine, is that broker exaggerating a little bit or what's going on? And of course, broker's going to exaggerate. Broker's going to give you the best possible situation when they do what's called their pro forma, their projection of the future, which we all have to do. You need to make a projection of the future based on on the past. So when you're buying a building, here's the key: you need to know what is, not what is future. You're going to project what the future is off of what is, and you're going to buy based on what is, not on the future, because you might be able to add value, and that's your profit, that's your upside. All right, you do not want to say, hey, I can raise these rents, I can do all this stuff, so therefore I'm gonna pay the price of what the building would be worth once we do all of that. You want to pay the price of what the building is worth today. And that's why you have to do this analysis. It's very, very important. And just a key thing about cap rate: the higher the better when you buy, the lower the better when you sell. Meaning that when you buy, the cap rate means a higher cap rate means the building is making more income. And investors, if you're buying in a high cap rate market, the market's a little softer. So you ideally want to buy in that. Now, when the cap rates are low and the marketplace has low cap rates, typically the market's a little bit tighter. Investors are willing to put their money out and make less return on it because of the competition in the marketplace. So when you're timing things, which market timing is important, you want to try to buy when the cap rates are higher and sell when the cap rates are lower. Okay, that's just a little bit of advice. My whole thing is, if you have an opportunity to buy a property and it makes sense, do it. But if you can time it to where, hey, I'm not bidding against Alibaba and the 40 thieves to get a property, you're coming in at a better place. And if you say, if it comes time for you to sell that property, you want to time it up to where, hey, Alibaba and the 40 thieves is making you multiple offers, and that's probably going to be a lower cap rate environment. So just a little bit, it's the same concept as like stocks, buy low, sell high, but it's different because you want to buy a higher cap rate and sell when the cap rates in the market are lower. And I know that might sound confusing. I got a YouTube station, Infinity Investments. You can go there. I got a whole bunch of videos on cap rate, NOI, where I bust that down. So it took me, by the way, a few years to kind of really understand this as I was young in the game getting it. But very important mathematical numbers, not to get too deep off into the math, but to just make you understand the importance of running your analysis and, you know, getting ready for the property. And I could stop the presentation, and this would be the main thing that I would want y'all to understand when it comes to commercial and investment property. Because once you go 5 units and up, the value is primarily determined based on this calculation. They are also going to determine the market sales comps like we do in residential, right? So in residential, primarily the value is based on what the comps are in your area and how your property compares to those. The comps in commercial are secondary. They're important, but they're secondary to the income approach to value, okay? And I know we wrapping up. You guys let me know about how
You got
long.
10 minutes.
Oh, perfect time. Perfect
Doing
time.
good.
So that's really, really important, but there's some other keys that we need to know as well. Okay, net cash flow. This is probably the most important because most of us are going to have mortgages when we buy properties. So the net cash flow is simply the cash remaining after all expenses and the mortgage are paid. So in other words, we talked about net operating income. That's the money you use to recapitalize that net operating income to come up with a value. The net operating income is what we use to pay our mortgage payment, the debt service. And what's left over after you pay that debt service is what's called the net cash flow. And that's an important number, okay? And that number you want to be higher than your cap rate if all things considered. You know what I mean? Well, here's what I mean by that. The cash on cash return is what measures the net cash flow, okay? Now, and let me break down what I mean by you want your cash on cash return to be higher than your cap rate, because that's a percentage number. And the cash on cash return is the net cash flow divided by the total cash invested, okay? And that, by the way, the total cash invested means you're not just your down payment, it's your down payment plus your closing costs, okay? A lot of people get to the closing table saying, hey, I got my 10% down, or in commercial, you got my 30% down, because in commercial loans, you do got to put a bigger down payment, by the way. For investment properties in residential 1 to 2 units, I'm sorry, 1 to 4 units, you can get away with 20, maybe 25% down payment, or if it's investment. Homeowner occupied, you can get in 3.5%, 5% down, possibly. When it's commercial, when it's 5+ units, you got to typically at least put 25 to 35% down, sometimes 35 to 40% down, depending on the cash flow numbers. But it's more of a down payment, right? So all I'm telling you right now, your initial investment is, or your total cash invested is the down payment plus the closing cost. A lot of people get to the closing table. I got my 10%, but they forgot about the extra 3% that might be transfer tax, loan fees, escrow fees, title insurance, property insurance. You got to pay. A lot of times by the way, when you get a mortgage, you got to pay property. Usually you got to pay property insurance for a whole year. And by the way, I know some insurance people most likely on this. You need to have a good property insurance person. All property insurance policies is not equal, okay? And you don't necessarily have to have, Allstate or Farmers, although those are great companies. You just need to make sure you're covered in relationship to what you have. And in business properties or in investment properties, they will insure you for the income as well, loss of income. So I know a lot of people who were able actually to try to get some money and got some money because of COVID and everything, and the loss of income because they had a loss of income event and they were able to get that covered. Some people were not though. So that's why I'm saying make sure you got a good insurance person that you're rocking with. And making sure that this cash on cash number is better than your cap rate. So if you came in and you got a cap rate of 6%, okay, and you got like a 3.5% mortgage, you're probably going to have a cash on cash closer to 7.5%, 8%. That's good. If you have a cap rate of 6%, and let's say you have a 5.5% mortgage, you may have a cash on cash because of the principal pay down of like 5%, meaning that your cash on cash is lower than your cap rate. So we don't like that because that means the loan that we got is taking away from our return. When we get a loan, we want to have what's called positive leverage. So that loan, we making money on the bank money, basically. You dig what I'm saying? Arbitrage. So we want to make money on the bank's money, not just break even on their money. Because believe me, they making some money on whoever money they get, and that's an important part of sustainability in the life of your investment. All right. So your cash on cash returns, net cash flow divided by the total cash invested should be higher, all things considered. And there might be some reasons out there, in the short term, you might buy where it's lower, but all things considered should be higher than your capital. The internal rate of return, I won't spend too much time on this. It's more of an institutional measure, but it's the total return on the initial investment on an annual basis once the property is sold. Now, here's what I mean total return. So in real estate, we know we talked about cash flow being the number one thing that we look at and break down, and the number one thing that we are evaluating in this process, right? However, it's not the only return that we get in the business. Every time you make that mortgage payment, in most mortgage payments, right, they're going to be amortized, meaning that you're going to pay principal and interest. So when you pay principal, that's paying down the loan. That's an element of return called principal pay down. All right. And hopefully we buying properties that are going to go up in value. If you own real estate long enough, it's going to go up and it's going to go down. By the way, it's not only going to go up. So I like to keep it real with y'all, right? You know what I mean? I love real estate. I live and die by real estate. I breathe real estate, but it doesn't always go up. It goes up more the majority of the time because it is a commodity that is in demand. And so what I talked about the cap rate environment is when you want to try to time things up, you want to buy right is what I'm trying to say. Okay. The internal rate of return measures all of those things: cash flow, principal pay down, appreciation, and tax either benefit or liability. So that's and that's what the big institutions use as a measure when they're looking at it. For most of our purposes, we're going to be looking at cash on cash return. Now, quick analysis, and I'll wrap this up. Cash on cash return, the formula, annual net cash flow divided by initial investment, or the initial investment is also called the total cash invested. And in this example, let's say the building yields $15,000 a year, and we put $100,000 down. Okay, what that means, we're going to take the 15,000 and divide it by the 100. That gets us 15%. All right. Now, I like to say, ideally, you want to get double-digit cash on cash return. I know a lot of us are here. I see it's a bunch of y'all there's a lot of 80-some people on this. So I'm sure it's some people who are either out of state from the Bay Area or maybe possibly investing out of state. I started my career investing out of state, and a lot of people can make money on it. So if you're going to go out of state, you definitely should be making double digits on your money. All right. In the Bay Area, that's very difficult. If you can make 7 or 8% on your money in the Bay Area, you're doing really well. Okay. In the Central Valley, like Stockton. Well, also, I'm going to say include Sacramento, LA, San Diego, and that if you can get 7 or 8%, you're doing really well. Most people getting 5 to 6% on their money. So if you can beat this, when you're doing investments, y'all, you want to beat the street. You want to do better than the marketplace, basically, as a rule of thumb. And so it's not a lot of 10% plus cash on cash returns in the Bay Area or in California in general. If you can get that, that means it's typically going to be a good deal. But if you're going out of state, every state's different. Everybody moving to Texas. I was looking at Austin, Texas commercial real estate. I'm like, dang, these are the Bay Area prices, pretty much. There's other parts of Texas, though, you can get some really good deals. So just make sure that your cash on cash, if you're going to leave the state, make sure it's double digit. If you're going to stay in the Bay or stay in LA, wherever you at, make sure it's worth your while, and make sure that number is higher than your cap rate. That's the biggest thing I want to say, especially for y'all in the Bay or LA or San Diego or Sacramento, because it's expensive out here. So now that's cash on cash. A quick other one, and I'll wrap, is return on equity. Once you own property, a big part of, many of us, we probably all play the game Monopoly. A big part of how you win Monopoly is you trade them 4 green houses and get you 1 big red hotel. So the next time somebody land on your red hotel, they got to pay you, okay? And so that kind of symbolizes doing what's called 1031 exchanges. You're taking the property, selling them, don't deferring the taxes and going to buy some more property. When you're doing that, and a lot of my clients are doing that now, a lot of people do that. That's how I know people who bought properties, houses, DP soaking 70,000, 80,000, Sold those 2 properties, about 56 unit apartment building in Stockton. You know, 2 houses into 56 units. Using, but here's what they did, and this is what you can do to figure out if that makes sense for you. You analyze your return on equity. So you look at a property's equity, the net equity of a property, that's the value minus all the loans and the cost of sale. And you look at that in relationship to your annual net cash flow. And the formula for that is you take your annual net cash flow divided by the net equity. And that's going to get you your return on equity. So you look and see is, hey, look, I'm only making 5% on this equity. When I bought my property, like say, like the previous example, put up 100, and I'm making 15 on my 100, but the property grew in value. Fantastic. My $100,000 of cash turned to $300,000 of equity. So I was making 15% of my cash, but I'm only making 5% of my equity. What if I were to take that property out and sell it and do a 1031 exchange? What could I do? All right. And if you were to do that, and this is how you can be, it don't matter your profession, it don't matter where you start in this game. You can start with one little house, work your way up, get a fourplex, work your way up, sell that fourplex, get 20, 30 units, whatever, using this formula. Because you see what, like, okay, the person put $100,000, they was making 15%. Their 100,000 grew to 300,000 in equity. Now they're only making 5%. If they simply went and said, hey, let's do a 10 sell and do a 1031 exchange. You could take that 300,000 and put it towards a new property. Now, if you're doing it like in today, the market probably went up since you bought it. That's how you got an increase in your money. So cap rates are lower. And we talked about that, more competitive in the marketplace. Now, you're not going to get that same 15% as you got before, right? But even if you only got 10%, let's say now on that 300,000, right, you're making 30,000 a year. What did we effectively do? We took our 15,000 that we was making on 100,000. Well, first of all, let's take a step back. We put up 100,000, bought this building. That 100,000 turned $300,000 of equity. Took that 300,000, it sold. We deferred the capital gains taxes by doing a 1031 exchange. Put that 300,000 into a building that now nets us 30,000. The percentage return was less. We effectively doubled our income. 4 greenhouses, 1 red hotel. And we did it without paying capital gains taxes. Okay, very difficult to do, something that you all can do, something that we all can do, that if we each one teach one, that we teach our community how to do, we can really make inroads on what's going on in the Black community, and particularly in our neighborhoods. We can build wealth, and when properties get sold, like sometimes they have to, we do the process like this exchange, we reinvest the proceeds, tax deferred, and we keep the train rolling. All right, that's a big example of how to get rich, get richer. Okay, and we can do it too. All right, and you know, I think we are poised to do it, and if we are focused in, like, you know, like look, it's 70 some, 78, 80 participants in this meeting, soaking up this game. Like you said, Miss Lisa, soaking up that nectar. You know what I mean? And putting that in motion. What can we do? What can we do for the next generation? What can we do for the now? And there is a shift in the marketplace. While single family homes are continuing to go up, already today, commercial property is in a bit of a down. Prices are not crashing, but we are in a tough, distressed period of time. And I'm putting a whole portfolio of bankrupt properties on the market in Stockton. I'm looking and tracking all the foreclosures. People are selling notes. There's deals that's coming. So now is our shot to go in here, maybe put 2 or 3 of us together, go buy up some properties and do it in a responsible way. Not like in 06, not like in 07, when we was just getting in properties and then losing. But we can go into these properties and hold on to them and exchange them up for bigger commercial properties and create serious amounts of wealth in our community. So that being, I got some other slides. I'm gonna wrap it at there, you know, and what I'm gonna say is just, you know, stay tapped in, y'all. Stay tapped in. I got some quality content. We're on YouTube, Infinity Investments on YouTube. You know, we do a lot of videos pertaining to commercial real estate and investments on a regular basis. But also all the speakers are gonna be here with you guys that Lisa talked about, all of the content that you can go out there and soak up. Please go out there and do it, and just stay on point with your game. And you might be a stock market person. You might be a cryptocurrency person. You might be a currency person. You might, flip houses. Whatever it is that you do, I would say put a little bit of investment rental property in your portfolio. And whatever it is that you do, stay locked in to soaking up this game, soaking up this knowledge, soaking up this understanding, and then share it with people, particularly in the Black community, for the advancement of Black economic excellence. With that being said, I want to wrap this presentation up and we can get to any questions that might be coming up.
Well, I want to thank you so very much, Mr. Steve Peterson. I can listen to you forever. And if you feel the same way, we encourage you to YouTube him on Infinity Investments. You'll be able to see all of his information where you have his website, you have his phone number, you'll see an email, you'll be able to contact him for your questions and answers. I also really, truly feel like a B-E-E. I feel like I have smelled the nectar of this Black economic empowerment that Mr. Steve Peterson has laid upon us this day. And I encourage you to make sure that you register for the very next session for Thursday, same time, for Nakia Carter, that's going to talk to us about credit, pre-approval process, and also home ownership. I want to thank you once again for each and every sponsor, the Women's Council of NARAB, the Oakland's African American Chamber of Commerce, and America's Small Business Development Centers for North California Network to be able to be here today. And I want each and every one of you, if you appreciate the wonderful information that we received today, give a big fat smile because you're on Candy Camera. We are about to take a picture. Juavette, are you ready to take our picture? And I like to say, you're on mute if you talk to us.
Hold on, sorry. You know I'm not ready.
Okay, not a problem.
Hold on.
I'll do it for you, Robert.
Thank you, Dr. Roche.
Dr. Roche.
All right, everybody, smile, get ready. It's a couple of pages, so look cute. All right, there we go. Let me go to the next page. And smile, smile, smile. All right, we done.
Thank you.
All
Thank
right.
you, Mr. Steve Peterson. And you guys, I will give Steve all your information. So we don't have any time for questions, but you guys contact Steve. He is somebody that is really out to help increase you guys Black wealth. Believe me, that really is his mission. So Steve will forward all the information to you as well to be able to help people. And you guys, please come back and join us on Thursday. Thank you guys all for being here.
Yes.
Thank you so much,
Thank y'all.
Steve.
Thank y'all for having me.
Mr. Peterson.
Thank you.
Appreciate y'all.
Thank
Much
you.
love.
It was
Thank
awesome.
you, Juavette. Yes.
Awesome and
Thanks,
amazing.
Steve.